Another common theme amongst the people in this room is that many of you are business owners. Let's focus on them for a moment. What are some changes that are going to impact the business owners?
Well, one of the biggest ones, and one of my favorites, is what's called QBID, which I'm sure you guys have heard of that, but it's Qualified Business Income Deduction, and that's the 20% of income from a qualified income from a business, and that can be from a sole proprietorship, a partnership, S corporation, and that was an automatic 20% deduction that was on your personal income. Well, that was made permanent. There's still phase outs for what's called SSTBs, and those differ than non-SSTBs. Like if you own an accounting firm, that's an SSTB. So we're kind of limited on it. There's phase outs. We're penalized for that. Just kidding. It's not favorable to a service industry anyway. But fear not, there is what's called the $400 automatic deduction. So if you're over the thresholds, you still get a $400 deduction. That's equal to about $178 of tax for those that are in the 32% tax bracket. So that's a little token that they give us. So it's kind of nice.
So my favorite part of this bill is what they did make permanent was bonus depreciation. So if you guys remember, TCJA started at 100% and phased down. It was going to go down to 0. This year was supposed to be 40%. They've made 100% permanent. So now you can deduct the full cost of equipment, lower useful life assets in the year that you get them. However, this is not effective January 1st. It's effective January 19th. So planning tip, if you bought an asset between January 1st and January 19th, place it in service after the 19th so you get the full 100% deduction instead of the 40% haircut. It also increased Section 179 to $2.5 million limit. So some of you may not understand the differences. I'll go through it really quickly. Section 179 is an election by asset that you make to deduct the full amount as long as you don't have more than the $2.5 million in total purchases for the year. Section 179 cannot decrease your income below 0. So any unused amount just gets carried forward. Bonus depreciation is an automatic election by class if you want to opt out. So 5-year useful life, 7-year, 15-year. You have to make an election by class, not by asset. You are able to create a loss using bonus depreciation, and there's no limitations. So even though it may seem like, hey, I want to do bonus over 179, you really also need to look at the state that the asset is in. Each state has adopted different rules with 179 and bonus. Some states allow it, some states don't. So again, that's where your CPA comes into play and gives you the advice on which one you get the better deduction for.
Another change that was made too was the research and development expensing. That was restored actually. The TCGA back in 21 actually made it where domestic R&D had to be amortized over 5 years. Well, the OB3 made it where we can either amend or we could continue amortizing over the 5 years, or we can expedite the expensing of anything left that has not been amortized. So this again is only for the domestic R&D, but that's a very powerful tool if you want to get with the tax manager. If that does affect you, we can tax strategize. They just came out August of this year, like Jeff was talking about, they're coming out with how to do things. Well, the IRS just came out in August of 25 on how to approach doing this, how to amend, what the steps needed to be done in order to do that. So another big one is if you guys own farmland and you're looking to sell it, well, a unique aspect is if you sell that ground after July 4 of 2025, you can elect to spread that over a 4-year period. That's, like I said, I feel unique. Instead of taking it all in 1 year, you make the election, spread it over 4 years. That's another tax planning tool where you can keep it out of the 20% capital gains rate.
I'll quickly mention the business interest deduction. They did make a change. It used to be 30% of EBIT, which is earnings before interest and taxes. They've changed it to be 30% of EBITDA. So it's earnings before interest, taxes, amortization, and depreciation. So capital intensive businesses now have an increased amount, which with that 30% limitation is on.
All right, well, I'm going to finish us up with a very brief mention of a code section that they modified. It's code section 1202. It's called qualified small business stock. And if you haven't heard of that, it's not surprising. It's a very unique provision, but it applies to any C corporations. And we're going to talk about if you're not a C corporation, but essentially it allows for people to sell their C corporation stock if they meet the definitions of the qualified small business to exclude $10 million worth of the capital gain. So folks that have businesses, whether you're a C corp or not, you really should, and if you're thinking about selling the business, you really should talk to someone about the idea of potentially converting to a C, especially if you're starting, because the new law, the old law was good. It had the $10 million. The new law for any business started after July 4th of this year, they raised it up to $15 million worth of capital gain. And I won't get into it because it's way too much and everybody's waiting to get to the bar, but there's a way that you can actually stack that and potentially get $5 or $6, $15 million on it, depending on how big your family is. So it is a way that essentially for people that start businesses with the idea that they do plan to sell them in a period of time. And the old law, you had to hold it at least 5 years. The new law, they have a 3, 4, and 5 year. You got to hold 5 years to get the whole 15 million, but you get benefits even after 3 years. So if you've got a business out there you're thinking about selling, you should at least have us explore whether or not the qualified small business stock exception would apply to you and whether it's worthwhile doing. But certainly if you're thinking about starting a new business, the default reaction to most people is I'm going to set up an S corporation because it has by far the best income tax benefits when you start something up. But if you're thinking about the end when you start it, you may want to start as a C corporation.